Hello and welcome back to Nothing Ventured. It's January 2026. I know it came all too quickly. A new year, fresh starts, and all the usual optimism that seems to arrive right on cue after a few weeks away from Slack, emails, calls, and pitch decks. And I think that's where we need to start because on the surface, venture feels calmer. Not euphoric, certainly not exuberant, but just calmer. That calm is precisely what makes January 2026 interesting, because it has been a month where markets seem to be actually moving. Capital seems to be deploying again. Deals seem to be getting done. People are talking more openly about IPOs, M&A, and exits, and it's not happening in whispered chats in the corridors. And for the first time in a while, it feels like we're not collectively waiting for the other shoe to drop. But, and this is important, calm does not mean normal, not by a long shot. I think part of the reason this calm feels strange is because it isn't relief, it's resignation. Things aren't suddenly going to return to the exuberance of the early 2020s. People aren't excited, they've adjusted. And that's a very different emotional state for a market that, for a long time, mistook momentum for progress. Because when you actually look at how capital is moving, where it's going, and who it's backing, you realize we're still very much living with the consequences of the last cycle. January didn't mark a reset, just as 2025 was not a return to normal. What January has instead done is marked a confirmation. Because the same forces that shaped 2024 and 2025 are still very much in play, just more openly and with fewer illusions left intact. Founders aren't waiting for valuations to bounce back, and VCs aren't pretending like there's a rebalancing happening. Lines have been drawn, and some of them are actually red. So this episode is really about one thing: what January tells us about how 2026 is likely to behave, not how we hope it will behave. The 2026 setup, disciplined optimism, but with scars. Now, most of the VC outlook pieces so far in 2026 use similar language: disciplined optimism, selective deployment, flight to quality. And to be fair, that's broadly accurate. The crash of 2022 and 23 forced everyone to slow down, founders and VCs alike. 2024 was spent pretending that things might snap back. And in some cases, it wasn't people pretending, it was them down on two knees praying. By 2025, most people accepted that the old normal wasn't coming back, if indeed it should ever have been called normal. So as we enter 2026, what January seems to be showing us is that capital has adapted. Checks are larger, but fewer. Diligence has become imperative again. There's far less tolerance for "we'll figure it out later," at least for most startups. And perhaps most importantly, the market has accepted and internalized that secondaries, continuation vehicles, and structured liquidity are no longer edge cases. Instead, they have become part of the integral scaffolding of venture. In a significant way, this indicates maturity in a market which for too long had seemed to be almost a parody of itself. Because the uncomfortable truth is that a large chunk of the unicorn cohort is still not ready, either operationally or maybe even mentally, for the public markets. And pretending otherwise helps no one. So yes, the pipes are slowly unclogging, but they're doing so in a much more controlled, grown-up way. And that is important context for everything else we're about to talk about today. So strap in. Section 2, AI in January, concentration, not expansion. Now, we have to talk about AI because, well, you know why. But the story in January wasn't AI is hot. That's lazy, derivative, and to some extent has matured away from that narrative. The real story is how violently capital is concentrating at the very top. Let's start with xAI, a reported $20 billion Series E. $20 billion. That's not a funding round in any traditional sense. Instead, it feels like a statement of intent, a declaration that frontier AI is being treated not like software, but more like sovereign infrastructure. And when you see valuations doubling in months and numbers pushing north of $200 billion, it becomes clear that we're no longer in a world where returns are evenly distributed, which, if we want to be precise, is kind of the whole raison d'etre of venture funding. But then you have Humans and a $480 million seed round at roughly a $4.5 billion valuation, just a few months after founding. And once again, the pattern is familiar. Alumni from the frontier labs, capital in the queue before there's anything tangible to point at, and investors underwriting people with a hope that the products will materialize. And this is the bit that often gets misunderstood. It's not that AI is lifting all boats. Rather, it's that a very small number of boats are being given jet engines and a surplus of rocket fuel. If you're a breakaway team from OpenAI, Anthropic, or DeepMind, the rules are different. You're not pitching revenue, real or projected. Your whole pitch is a declaration of inevitability, which is great for those startups and those founders. But for everyone else, the vast majority of founders building genuinely useful AI products, the bar has gone up again. January seems to be making that painfully clear. The middle is not being rewarded, it's being squeezed. And that goes for whether you're building a startup or you're a VC on your third fund. The second order effect of this concentration is a subtle one, but it is important because it changes how founders pitch, how VCs present themselves, and ultimately how risk gets priced. If capital believes that the winners are already evident, everyone else has to behave more defensively. Shorter horizons, earlier monetization, less experimentation. Because simply put, even outside of the foundational models, capital is just flowing into fewer ventures. And even when it does, it's taking a lot longer. Section 3, Emergent and the return of useful AI. Let's talk about why the Emergent round is interesting, and not just because they've asked to come on my podcast. A $70 million Series B led by Khosla and SoftBank Vision Fund 2, with a serious syndicate behind it. But what matters here isn't the size of the round. In the context of what we've just talked about with XAI and Humans and, it feels like a bit of an anticlimax. But what is important to understand here is why the market decided to show up. Because Emergent isn't selling AGI narratives or moonshots. Instead, it's selling speed. The idea that non-technical people can go from idea to monetizable software without needing a team of engineers is incredibly powerful, not philosophically, but economically. And when you see metrics like rapid ARR growth, millions of users, and global adoption, it reinforces something important about 2026. The AI products that are winning are the ones that shorten the distance between intent and outcome. This isn't about how flashy they are, how hyped they have become. It's about how quickly they build utility, because utility leads to value. That's a very different dynamic from the frontier lab world, and it's where most actual businesses reside. Section 4, Brex and the FinTech Reckoning. Now, given the state of my X feed last week, I think it's only rational that we talk about Brex. Capital One acquiring Brex for around $5.15 billion is, in many ways, the most honest deal we've seen in quite some time. Because despite what a number of VCs and even founders seem to believe and to be saying, Brex was not a failure. Brex wasn't a fraud, it hadn't been poorly run, but it was priced for a world that simply no longer exists. A peak valuation of $12.3 billion in the early 20s met a reality where growth margins and capital costs matter once again. And this is the reckoning that a lot of late-stage venture is either going through or is going to have to face up to pretty soon. And fintech is a good indicator of what sort of outcomes the non-venture world can bank on. Because banks want technology, they want distribution and modern interfaces, whilst fintechs want balance sheets, regulatory cover, and permanence, which is precisely why consolidation makes sense. But for venture, the lesson is stark. Paper valuations are not exits. And if you think a company exiting for multiple billions, founders and employees walking away with millions, and most early investors enjoying actual liquidity is a failure, maybe you need to ask yourself whether you're more interested in the optics than the actuals. January reinforced something many people already knew, but don't like to say out loud. The last cycle pulled a lot of outcomes forward, and now the market is patiently, methodically unwinding them. Section 5. Early stage reality and European ambition. Away from the headline rounds, early stage activity in January looks healthy. We haven't gone back to manic financings. We seem to have moved away from frozen markets to something that looks functional. Funding is clustering across sensible bands, enterprise, climate, healthcare, and AI. Tooling continue to attract capital. Consumer remains tough. Crypto remains selective. In Europe, the all too familiar paradox remains. We have world-class talent. We have world-class science led by world-class research. We continue to spin out genuinely important companies. But as has been the case for all too long, depth of capital and exit velocity are still lagging behind. Regulatory consultations, pension reform, capital markets plumbing, all of that matters. Of course it does. But it moves slowly, and the changing of the year doesn't magically fix decades-old structural issues. But what we seem to be seeing is intent, and intent is at least a start. And as a European operator, this is the part that I keep coming back to. We are clearly capable of building, but the open question, the one no one seems to be able to answer, and that whatever has happened this month doesn't resolve, is whether we're willing to back those builders for long enough and at enough scale to let them stay. What January really told us. So what did January 2026 actually tell us? I think it seems to have signaled that the panic phase is over, that capital has adjusted and will continue to adjust. It has signaled that illusions have largely been stripped away, though there are always a few people that didn't seem to get the memo. And this is important, we are seeing that this is a narrower market than it used to be. The rewards are bigger at the top, whilst the tolerance for mediocrity is lower everywhere else. And in case this wasn't yet apparent, the venture flywheel only really spins when liquidity becomes real again. January wasn't exciting per se, and that's probably no bad thing because boring, functional markets are where real companies get built and real value first accrues and then gets distributed. I'm Arish. This has been Nothing Ventured News for January 2026, and as always, stay liquid.